switch gears to Mr. Mark Willis. So, part two of Not Your Average Inflation. Mark joined us yesterday. By the way, Mark, I apologize to everybody who was initially here. And I said, hey, look, I felt like I rushed Mark yesterday. Luckily, he's coming back for part two today. And if your schedule allows, we can go for long. But if not, completely understand. Because what you're talking about, like all the other topics, I almost backed myself in a corner there, is extremely important, right? So,
Absolutely. Yeah. Well, inflation impacts everything else. If you're dealing with money, it's going to impact everything else. So
I
that's
paid
the,
$4 a gallon of milk at Aldi yesterday, which we normally pay like $2.75 or whatnot. We drink 5 gallons a week. Okay, we're gonna
Mhm.
go bankrupt just drinking milk. I mean,
Yep.
it's crazy. We're not really,
Well,
but
we're switching to lettuce, milk, and bug protein and whatever else you have to do. No, I'm just kidding. We're going to come up with some better strategies than that on our
good.
quick presentation today. So I'm gonna jump right on in if that's all right, and I hope to leave some time for questions.
You bet.
So I'm gonna see if I can share screen here, and we'll jump right in. So we
By the way,
talked,
if you
yeah.
didn't see part one yesterday, if you're just joining us here for the second piece, part one will be available. The recording will be available. Make sure to get those out to you when they're ready.
Guys, we're here to talk about increasing your own money supply. We are going to do a quick recap of yesterday's part one. Then we're going to get into some specific strategies and some common myths about how Bank on Yourself is impacted by inflation. So we're going to cover that together today. Again, the presenting issue is that in 1990, we had a population of 250 million people with about $2 trillion sloshing around in bank accounts and wallets and so forth. And now we've seen our population grow by just 25% to 330 million as of this year. But we now have 10 times as much money floating around. That is that is the smoking gun of inflation at work over the last 30 years. All right. So we talked some about how you can protect yourself, and I jokingly brought up lettuce steaks and bug protein as an option. But we have some better strategies. And we got into some of them yesterday. We talked about the myth of high rates of return in the stock market. We also talked about the advantages of real estate and also how real estate is going to be negatively impacted by inflation as mortgage rates continue to rise and so forth. Then we brought up the idea of Bank on Yourself, which is using a little known variation of dividend paying whole life insurance to give you three crucial strategies in your financial tool belt. The three strategies that I believe are going to be the small hinge that swing the big doors in your financial life are the power of uninterrupted compound growth. These policies are growing on a guaranteed and compound schedule every single day, every single year. My clients, it's wonderful to say it. I kind of jokingly say it as I'm talking to my staff, but I say, hey, guess what? All of our clients just hit a new lifetime net worth maximum today. Once again, we hit an all-time record high on net worth. Once again, regardless of market volatility. So the power of compounding is crucial in the Bank on Yourself concept. Second, the power of leverage, how we can use the power of leverage not against us, which is how inflation destroys our wealth, is through leverage, but for our advantage, how we use the policy itself for continuous compounding, even when we borrow against it. And then the power of optionality, again, this power of being able to keep our money in motion, the velocity of money is so huge when it comes to inflation, because if our money sits still in a savings account, we're like sitting on the target, right? And you got to get off the target when it comes to inflation. So the power of optionality means we don't have to choose between mobile home parks and Bank on Yourself. We get to choose both and. It's a both and. In fact, I literally have done that myself, but there are other strategies included that our clients are doing all across this country and across the world to put their money to work, both with Bank on Yourself and whatever asset class they might want to put their money to work in. Okay, so it's one of those it's one of those not hurry up and wait. It's more of a wait than hurry up when it comes to inflation. Inflation has happened quietly over the last 40 years, and then boom, all at once, it seems. We've seen a tremendous drop in many of our favorite stay-at-home stocks like Netflix. It's dropped 85% from its high. We've seen a lot of the ARK Innovation tech stocks dropping like incredibly over the last 6 months or so. But the not so average participant of this summit knows that there's more to the financial universe than just the stock market. And you're here because you know that real estate is a big part of the piece of that equation. But many of you guys might also know that there's another mega market that's booming across the world, and really it's crashing across the world. It's known as the bond market. Bonds are crashing. And no, I'm not talking about that bond, although he's gone through plenty of crashes as well, James Bond has. But it can often feel like a future shock when we start to see yield curves inverting, if that makes any sense. When we start to see the 10-year and the 30-year note, treasury note flipping, people are favoring the wrong side of that bond curve. And you're not just reading tea leaves. The flipping or the inverting of the bond yield curve is actually a perfect correlation for every recession we've ever had. Guys, this is a big deal. And so as of this recording, we're getting dangerously close to a yield curve inversion, which might just mean that a recession is upon us, or in fact, we might already be in one. Guys, maybe you don't remember, but in 2007, we were already in a recession. We just didn't realize it yet until the fall of 2008. All right. So the bond market has been crushed the last 6 months. In fact, from January to April, we've seen the worst 4-month period that the bond market has ever seen. Let that sink in for a minute. A multi-trillion-dollar market is in its worst phase that it's ever been in all of recorded modern human history. That is not a small thing to say. And I don't pleasure saying it, but that's the reality of where things are at financially right now. So I'm not here to prognosticate on where we're headed, if we're going into recession, if we're going to have a boom result from this, who knows? I'd like to focus mainly on who are the players in this major market, the bond market. How does it impact bank on yourself type whole life policies? And specifically, what can you do with the bank on yourself strategy to better yourself financially as we head into higher interest rates? Okay, so now if you've been investigating the bank on yourself concept, if you've been hanging around the W-2 crew like like the coolest kids are, then you know that in many ways, life insurance companies that back the bank on yourself concept and are using dividend paying whole life insurance, which is the kind of insurance required for a true bank on yourself policy, you'll see that these insurance companies on their balance sheets have a heavy weighting toward bonds. Now, I just said that the bond market is crashing. So does this spell the undoing of insurance companies? Or are we about to see a massive bankruptcy and implosion and the unraveling of the entire bank on yourself concept? After all, aren't bonds just, imploding? Aren't they risky and losing value right now? No, certainly. Well, we'll find out for sure, but certainly there's no financial institution that could completely withstand a major financial crisis. And let's not forget, we just went through a health crisis too. The pandemic definitely would put pressure, I would imagine, on insurance companies, right? So the first thing you got to recognize is that not all bonds are created equal. So we cannot lump all bonds together. And many people also start to say, well, hey, let's just forget this life insurance stuff. And hey, the insurance companies are basically a giant bond fund. This is what I hear people say sometimes, myself included, when I was first learning about this strategy. They say, hey, if you buy life insurance effectively, it's just basically a giant bond fund. Like the insurance company is kind of just a big mutual fund or something. So instead of me putting all my money in a 401k, let me put my money into this life insurance. And hey, yeah, technically, if I die, I'll get some sort of death benefit. But it's essentially the same thing. I hear people saying it's the same thing as putting your money into bonds. All right. So, and the way the world is right now, you don't want to put your money into bonds, they say, because as interest rates go up, bond values will go down. And right now they're going down in a very big way. So won't this ruin the whole life insurance industry? Won't it destroy the balance sheets of these insurance companies? And thus, won't it destroy the guarantees of the whole life policy? So why would anyone want to put their money into whole life insurance if interest rates are rising? Won't that kill the insurance companies since they're just giant bond funds? That's kind of the question that I've heard rumbling around in my own brain and in the conversations I have with clients. But is bank on yourself just an expensive bond fund? And the answer is no, definitely not. Let's talk about what happens when you put money into life insurance policy. So here are 4 little buddies here, and they're all going to put their money into a whole life insurance contract in this case. So they're going to pay their premiums over here to the insurance company. And that insurance company does what with it? Are they going to put it in a shoebox somewhere? Are they going to put it into meme stocks like AMC and GameStop? No, that'd be kind of cool, but no, they gotta do something smart and savvy with it, because they now owe policyholder families tons of money. So they got to be safe and predictable with that cash. So what are they going to do with it? Well, they're going to sit on a lot of it in cash in case they need to pay out a death claim or something today. But they're also going to put a bunch of money into here's some examples, some mortgage debt, some municipal bonds. A lot of it is corporate bonds. Which, what do those do? Well, they go to build new factories, schools, home renovation, office renovations, hotels, bridges, and that money is then, going to build and develop the economy that we all enjoy. I mean, Apple, for example, issues bonds every year to build their new iPhone, and guess where they're getting the money to build those iPhones? It's coming from insurance companies. And as that money begins to kick out revenue, as they sell those iPhones, or as they build that new hotel or whatever, that money goes right back to the insurance company that lent out the money, which goes back to pay the benefits and so forth of policyholders. So that is the business model of the life insurance industry. So they are not a big bond fund. They're simply just using that capital to sit on and wait until the right right maturity of claims comes to be. All right. So does this mean that bank on yourself is invincible? No. If the economy crashes so bad that companies like Apple or GE or others go bankrupt, and a bunch of these corporations that had issued bonds with insurance companies default, yeah, at some point, if there's like Mad Max style, destroying kind of economies, then even the strongest life insurance company is going to feel some pain. I guess I'm just saying that, hey, if we know interest rates are going to go up, it doesn't mean like ipso facto that the insurance industry is going to get decimated. In fact, back when interest rates were at rock bottom rates, they were pretty low there for the last 25 years. People were saying, why would I get into whole life insurance when interest rates are so low? And how could the insurance company even do business with insurance interest rates so low? So it's sort of like people are saying, hey, bank on yourself won't work with low interest rates. And then they say, hey, bank on yourself won't work when interest rates go up. So you got to make up your mind, right? So this is sort of the concept that I'm just trying to, I guess, dispel that common misbelief about insurance industry writ large. Now, about all that, that's fine. That's whatever. That's great. But what is it that we're actually doing when we have a bank on yourself policy? Remember, the point is not to invest in insurance, and it's certainly not to get into bonds, especially not these days. Bank on yourself is a cash flow management system. It's not about interest rates. It's about bringing the banking function back down to the you and me level. And this is, I think one of the most important things you guys that we all can do is to bring the banking function back into your own life. We have all, unfortunately, we've outsourced it to many other banks. But what if you could bring it back into the you and me level where you're able to become your own source of financing? Now, when inflation rears its ugly head, don't forget, whole life insurance premiums are level. They do not go up. Whenever inflation rises, that means your premiums are getting easier to pay. Your cash value and death benefit grow according to the insurance company's profits. So I guess I got to say, we got to start partying like it's 1980. So Jay, you're going to have to grow your hair out.
I didn't know we were looking at your school portrait here. That's amazing. That's incredible.
That's a mad mullet right there. Well, why am I saying party like it's 1980? Because guys, back in 1980, mortgage rates were 17, 18, 20%. And guess what? We've got the history, we've got the background, we've got the evidence that whole life insurance dividends go up when interest rates rise. Dividends in 1981, 82, and so on, they were in the 12, 15, 18% range. So we were able to keep up with inflation when inflation rears its ugly head. This is actually a picture. Now I took the name of the company out, but this is a history of the dividends that have been paid since 1900 up until present day. And the data just stopped at 2018. It's a year or two old, this chart. But they've never missed a dividend in over 100 years. I just want you to think about what was going on in the world in 1929 when they were paying out tens of millions of dollars. Is that right? In that year alone, and that's in those days dollars. Now we're looking at billions of dollars paid out in today's dollars, and this is in the midst of stagflation, inflation, deflation. Insurance companies that we like to work with have paid out a dividend without fail for over 100 years. All right, so as we wrap up, I'm going to try to wrap this up a little early, so there's a few minutes for questions, as we have some. I wanted to talk through an example case here. This is somebody who, now please forgive me, I had to get some sort of numbers on the screen, and I realize that might be tough if you're not able to see the screen. So what we're looking at here is a 41-year-old who has a policy where he was able to put in $400,000 as a single lump sum. Now, please understand, you could take one or even two zeros off of that number, and this strategy would work just the same. Don't let the numbers dissuade you from just following along here. This is just to show you the concept. Now, first and foremost, if you put 400 grand into a single premium policy, that means there's no additional bills to pay. This thing is totally done, and it's just going to work for you for the rest of your life and grow on a predictable and even guaranteed basis. Now, this guy, he puts in $400,000. Again, feel free to add or take away zeros as you wish here. The numbers work just the same. But he has a cash value in the first year, and actually the first 30 days of after starting his policy, he has a cash value, which is incredibly large. The number here says $378,000 in year one. So that means almost all of his money, 90+% of his money, is liquid and accessible cash right away. Now, why doesn't he have all 400,000? Where did some of that money go? Well, it went to buy that giant $1.7 million death benefit right there. All right. So he puts in 400 grand. He's got $378,000 day one, essentially. And he's got a $1.7 million gift to the family. Is that a good deal? I'd say. When does this thing break even? He lost some money. If you kind of look at that carefully there, looks like he has $411,000 in just year three. That more than beats my savings account, at least my savings account. Sure beats CDs and so forth.
Every savings account.
Yeah, exactly. You bet, man. These policies are going to keep up and even beat most other cash buckets you could save your money in. And they're not getting taxed every year either. Most folks don't realize it, but the 13 cents we got paid on our savings account last year, Jay, we had to give 6 of those cents to the government.
Yeah.
But this is a non-taxable account. Yeah. So this offsets the impacts of inflation. And by year 8, this is the one number I want you to really remember, guys. He puts in 400 grand in year 1. And by year 8, he's already got $507,000 in cash value. Now just keep that $507,000 in mind for a moment, because we're going to go check out what he's going to do with this money. I don't say, hey guys, just open up whole life insurance and just let it sour in there. No, I want us to work with Victor. I want to work with Jay. I want to work with, Brandon. I want to work with all the awesome people that are on this summit this week. And I want to put some of this money to work. So what if I took a giant policy loan in the first year? This guy takes a loan, a policy loan. You can bank on yourself and borrow against the policy. This guy takes, of his $378,000, he takes his loan for $360,000 to buy a multifamily deal or whatever he wants to do with it, right? Storage units, mobile home parks, whatever he wants to do. That's $360,000. And he repays that loan over 8 years. Now, how might he do that? Well, I'll leave it up to the pros on here, but maybe it's cash out refinances. Maybe it's selling the syndication. Maybe he's getting rent money that pays it off over 8 years. It's up to your particular investment. But after 8 years, he pays off the loan. And after year 8, the loan is completely paid off. And he's paid for the policy loan an interest of 2.1% or $54,000 over 8 years. Now, guys, you know mortgages better than I do. How are mortgages looking these days? Are we getting 2.1% most places? Nope.
No.
That's pretty darn good for getting access to cash. But in the meantime, his policy continued to grow as if he had never touched the money. Remember that number I mentioned earlier? $507,000 on the previous screen there. Well, yeah, by year 8, even though he had taken that loan out, his policy still has $570,000, which means he had a total policy growth in the first 8 years from 400 grand to 507. That's an increase of $107,000. Now, wait a minute.
Mark,
He did pay some interest.
let me ask you a question real quick.
Yeah.
Let's say for some reason he didn't pay that loan off in year 8. You know, and maybe it's closer to year 10. Do these returns still look the same? Does the spreadsheet still look the same?
It does. Yeah. Now he'd pay a little more interest since he's taken longer to pay off his policy loan, but we're talking, maybe 2.3% interest instead of 2.1 or whatever. These are just favorable loan interest rates. It's always, and if he passes away and never pays off the loan, then the death benefit would just be reduced by his loan balance. Okay. Now, the key piece here is his money was doing two things at the same time. What we see here is the growth of the policy. It grows whether you borrow against it or not, just the same. All right. What we don't see is all of the appreciation of his real estate, all the rental cash flow that he's received, the tax advantages. All we see is that he earned $107,000 and he spent 54 grand to borrow the money. That means he had an arbitrage of $53,700. And he says, how do I do that again? That felt good. I want some more of that. Right? So that's his arbitrage in the first loan. Let's kind of zip down to the 10th year, excuse me. And in year 10, he now has $551,000 of cash value. Remember, he only put in 400 grand all those many years ago. He takes a giant loan of $550,000 for another multifamily deal. And again, he repays it in 8 years. After that 8-year period, he's paid $74,900 of interest. Again, about 2% annual percentage rate. His growth was $734,000 was the cash value at the end of that project, which means he grew his policy another $182,000. Where's the savings account doing that over 8 years? And so this means his arbitrage is now $107,000, guys. In other words, this policy is getting more and more and more efficient the longer you keep it and the longer it's in force. So if you're a solid, honest banker with yourself, you can overcome the impacts of inflation and take advantage of real estate opportunities. Again, the numbers could be 10 times smaller than this or 10 times larger. Every policy is custom designed, but they're all going to help you in your efforts of, taking advantage of some of the awesome real estate opportunities that we'll all see coming down the pipeline in the months and years ahead. So let's get you guys ready for the fight of inflation, the fight of your life with inflation. The best website to go to is w2capitalist.com/bank. All right. So I did it. We got 5 minutes.
Yeah. Victor asked a question. Are you getting a bank loan against a policy or borrows from the insurance company?
Yeah, great question, Victor. In this case, the policy itself is being used as collateral, and the loan, thankfully, is coming from the insurance company. This is a big deal because you don't have to get approval from a bank. There's no credit check. There's no net worth statements or balance sheets you have to submit. If your cash value is there, you're good for the loan as far as they're concerned. And it takes you maybe 4 or 5 business days to get the money out of the policy and into your checking account where you can spend it.
And that is 100% true because we just did that with so try to make a long story short, we're trying to do a home equity line of credit on our primary. And I talked to a few banks and they're like, oh, you've got a loan for a utility trailer, which they offered 7% or something like that. Sure, I'll take it. Well, apparently it just got to be this thing, right? These banks don't like seeing utility trailer loans on your balance sheet. So I submitted this process. It was like 2 weeks ago. No, it was last week. And the money's already in our account, right? And it's paid off and it's incredible process. So, Ivy asked, any other additional fees had to pay monthly other than the $400,000? So can you talk about the structure of how you can fund a real estate? Because I when you and I connected and me and Cassie and I and you connected and we structured this thing together. We do ours on an annual premium, right? Which something you said a minute ago was premiums get easier to pay over time. And I've never thought about that because I sometimes stress over the amount we're putting in there, but then I see the benefits of it. And then as you just so elementary put it for me to understand it, as you always do, Mark, so thank you very much, is that over time that $25,000 that we're putting into it every year, it's going to get a lot easier to pay because of inflation.
Yeah.
Right.
And
So
renting a term insurance policy is the opposite problem, because as you get older, prices go up on term insurance, but it's flat and level with whole life insurance, getting easier with inflation.
Yeah. Yeah. So can you talk about how to structure some of these policies? And I know there's intricacies on every one of them, and that's why we've set up this link. By the way, didn't say this earlier, just a disclaimer. So Mark is my certified financial planner. He's also a sponsor of the W2 Capitalist podcast or W2 Capitalist community. So if you go to this site, you're going to see a form to fill out that'll connect you to him. You guys can get on and have a conversation. I use him. It's changed the trajectory of wealth building for my family. If you want to talk to me about it, let's connect. But let's talk about how these different policies can be structured, one lump sum up front or over time. And
any of the above, all of the above. In fact, you can have multiple policies doing different things. One of your policies might be this single premium idea that I just showed you, and another might be, paying monthly with your cash flow. Another one might be annual chunks that you're dumping into the policy. We've got any number of customized ways to do it. The key is to sit down one-on-one with a professional who knows what he or she is doing to build it straight up from the ground up.
Yep. And don't stop at just one. You can get multiple. You don't have to settle on just one strategy, and you also can do it for your kids. So, which I absolutely love. We're almost there, getting that thing kicked off for our kids.
What bank stops at one bank branch? Don't they want to open up more bank branches? You bet, man. Yeah,
that's true. Yeah. Davian asked, how can you use it to accelerate paying off a mortgage?
Hey, Davian, great to see you, man. Yeah, this is a great one. Just had a guy. He built up enough money in his policy, and he continued to pay his monthlies on his mortgage. So his mortgage is slowly coming down, and his policy is getting just shot into the stratosphere with more and more cash. And at some point along your journey, if you want to, you can borrow against the policy and pay off the mortgage. And this guy I just helped out with, he did this. He actually took a photo of his mortgage in the fire pit. And now he bought back that mortgage. He is the mortgage company to himself. And now he has complete control. If he needs to lower or stop that monthly quote mortgage payment to himself, he can do it. But now he's the one driving the train. So,
because if he doesn't pay, then I guess he's going to go after his own knees. I don't know. I don't know
That's
how
right,
that works
man.
yet.
That's right. Yeah. With every policy, we'll send you an Uncle Guido if you want one.
Yeah. What are the questions? If you guys want to come on and ask instead of typing it in, just raise your virtual hand and I'll call on you. That way we don't get flooded with people talking over one another. But this strategy, you're essentially investing the same dollar twice. And if you're like me, you think, what in the heck? This is some kind of voodoo stuff. Mark's pulling one over on us. I think we're on our third year. Everything that Mark has said has been true, and it's led us to really build some wealth for our family, buy an RV, do a lot of traveling, pay off a utility trailer. It's good stuff. Good stuff. It's amazing.
Yeah, it's no magic on my behalf, man. I had to discover it too. I'm just trying to, like one blind beggar sharing the bread with somebody else, just trying to let folks know it's an option, So it's great stuff.
Becca asked, would loans be taxable in a single premium policy?
Yeah, great question, Becca. That gets into some of the different design elements of these policies. Single premium policies live in a different tax environment than annual premiums. I show that simple single premium to make things real simple for today's conversation. But the tax law is a little different on single premium policies, which again is why you might want to have two policies, one that's single premium like that if you happen to have a giant chunk of cash just laying around, and you might have another one where I actually referred to this as the two-stage rocket strategy, which we don't have time to get into, but let's just say you can use different policies for different purposes, much like different stages of your rocket. All of it helps you get out into space. Julia, nice rocket emoji there. Yeah, great question, Becca. Let's talk more if you have more questions about that.
Any other questions? That's Mark's reminder. He's got to get going to his next speaking opportunity, right?
Oh yeah. Yeah. And William, happy to chat with you about tax benefits. There are incredible tax benefits that I found over the years, but just don't have time to talk. Just reach out to us. Go to w2capitalist.com/bank. Happy to chat.
Thank you, Mark. Thank you, Victor, if you're still around. Guys, we're wrapping up day 2 of the virtual summit, and I want to make sure you all know about this upcoming event on Friday. This is something we just now added to. Can you guys see my screen, by the way? Can I get a couple head nods or thumbs up? Okay, thank you, Ivy. Thank you, Mr. Rush. We are going to have a virtual happy hour on Friday the 13th. If you're superstitious, I apologize. You shouldn't be. No number. I don't know. Anyway, I'm not going to get into that. But look for an email from me coming up on Friday to give you the link, the correct link to join us for happy hour. What we're going to do is that for the presenters that are available and for the attendees that want to, just come and talk shop, come in, and we're going to do a virtual happy hour. We'll do some breakout rooms, all sorts of fun stuff. So mark your calendars. And the reason I'm pulling it up today is that this was not mentioned in any of the previous marketing materials or anything like that. So I want to make sure you guys know about it. Go ahead and put it on your calendar from 4 to 6 Eastern time this Friday. We'll be doing the virtual happy hour. So that's it, guys, for today. Unless any other questions. Julia's still around. Mark had to jump off, like I said in the chat. Julia, thank you for being here. I know you helped keep Mark on grounded and whatnot. So, all right, guys, that's it for day 2. We'll continue this party tomorrow. Day 3, we've got Eva Holland scheduled on the first session, and then following her is Cody Fisher. Eva's going to be talking about beginning in short-term rental Airbnb business, which is such a hot topic these days. And then also Cody is going to be talking about asset-based lending for 1 to 20 unit properties, which recently introduced to this whole concept. Just closed on my first asset-based loan, and the only thing I had to provide to them was a copy of my credit report and leases, nothing personal, which was amazing because I'm going through this HELOC process with a traditional lender, and they are reminding me why I started the bank on yourself policy concept. So anyway, guys, have a great rest of your Tuesday, and I will see you tomorrow.
It begins with a thought, an idea that keeps growing in your mind. You spend days, months, or even years just simply thinking about it. There are many ways to get started, take action, and make progress, but both you and I know the best way is to have a guide as you surround yourself with like-minded people. Peers who are on your level that are actively taking the next step. You'll feel empowered and your confidence will breed confidence. Having so many options to choose from when purchasing a real estate investing educational program, you'll soon find out that just a few will understand your thoughts, your fears, and your expectations. For the next 6 weeks, I will be your coach. Grasp your vision, create realistic goals, and diligently apply what I've learned from investing since 2014, and deliver a framework for you to build your experience and portfolio. Seating is limited. Register today.